Imagine holding a goose that lays golden eggs. Would you cut it open for a one-time feast or let it keep producing wealth year after year? That's how Belgium's leaders describe the 200 billion euros in Russian sovereign assets frozen in Europe since Moscow's invasion of Ukraine. Belgium's new foreign minister, Maxime Prévost, has warned in stark terms, if the European Union seizes those assets outright, the result could be a terrible systemic shock, one that risks shaking the credibility of the euro itself. His warning has reignited a debate at the heart of Europe's response to Russia. How far should the West go in turning Russia's frozen wealth into Ukraine's war chest? To understand the stakes, we first need to grasp the numbers. When Russia launched its full-scale invasion of Ukraine in February 2022, Western allies moved swiftly to immobilize Moscow's financial firepower. Around $300 to $330 billion in Russian state reserves were frozen worldwide. Of that total, the European Union holds the lion's share, roughly 200 to 210 billion euros. And within the EU, nearly all of it sits in Belgium's Euroclear, one of the world's largest securities depositories. Euroclear is a crucial node in Europe's financial plumbing. It processes trillions in transactions daily, holds government bonds, and ensures collateral flows smoothly through global markets. For Ukraine, these frozen funds represent a tantalizing potential lifeline. For Russia, they are a humiliating symbol of lost power. And for Europe, they are a double-edged sword, too politically and morally valuable to ignore, but too economically risky to confiscate outright. So far, the EU has pursued a cautious middle path. Instead of confiscating the principal, Brussels has tapped into the windfall profits generated by the frozen Russian reserves. Here's how it works. With interest rates elevated, Euroclear has been reinvesting the immobilized Russian funds in safe assets. Those investments have generated billions in profits, expected to reach 15 to 20 billion euros by 2027 if current conditions hold. The EU agreed to redirect those profits to support Ukraine, including backing a G7 loan package worth $50 billion. This system has allowed Europe to channel money toward Ukraine without crossing the legal red line of outright seizure. But there's a catch. The profits depend heavily on interest rates. If the European Central Bank cuts rates, the profit pool shrinks. That creates uncertainty about how sustainable this revenue stream really is. Still, for now, the compromise has held. Brussels presents it as a way to punish Russia, help Ukraine, and avoid destabilizing the euro's reputation. But pressure is growing from hawkish countries like Poland and the Baltic states to go further, and that's where Belgium is pushing back. At the centre of the resistance is Belgium's Maxime Prévost, who took over as foreign minister in July 2025. His message has been blunt. Confiscating Russian sovereign assets is not an option. Doing so, he argues, would be politically driven rather than legally grounded. And that, he warns, risks sending a catastrophic signal to global investors. Prévost's fear is that Europe would be undermining the very principle that makes its currency valuable, trust. Central bank reserves are supposed to be sacrosanct, immune from arbitrary political seizure. If the EU breaks that rule, he says, it could drive other countries, think China, Gulf states, or emerging markets in Africa and Asia, to pull their reserves out of Europe. Belgium's Prime Minister, Bart de Wever, has gone even further with his now famous metaphor. He compared the frozen Russian assets to a goose that lays golden eggs. Cutting it open by seizing the principal would produce a one-time payout, but leaving it intact, he argued, provides a steady stream of income for Ukraine with far less risk of backlash. This isn't just rhetoric. Belgium has a unique stake in this debate. Since Euroclear is based in Brussels, any reckless move could expose the country to lawsuits, retaliation, and financial disruption. Euroclear has already taken hits. Russia froze assets belonging to some European investors inside its own territory, and Euroclear has tried to offset losses of about 3 billion euros. For Belgian leaders, this is proof that Russia will retaliate aggressively against any further escalation. So Belgium is planting its flag firmly. It will support using profits, but it will not endorse full confiscation, at least not without a peace settlement or an international legal ruling that shields the euro from reputational damage. So why exactly does Belgium fear that seizing Russia's frozen assets could trigger a systemic shock? Let's break down the main pathways. The euro is the world's second most held reserve currency after the US dollar. Central banks around the globe, from Saudi Arabia to India, keep euros in their reserves precisely because they assume those assets are legally protected. If Europe sets the precedent of confiscating Russian reserves, other governments may begin to wonder, could our money be next if relations sour? That uncertainty could spark a slow but steady diversification out of euros. Reserve managers might shift more funds into dollars, gold, or even China's renminbi. Even a modest rebalancing could put downward pressure on the euro and raise borrowing costs for EU governments. International law recognises sovereign immunity, meaning a state's central bank assets are normally shielded from seizure. Some legal scholars argue that confiscation could be justified as a countermeasure against Russia's aggression. But others insist that unilateral executive seizures would clash with international norms, leaving the EU vulnerable to years of lawsuits. The result could be legal uncertainty for financial institutions like Euroclear, which rely on global trust. And as any investor knows, uncertainty is poison for markets. Euroclear isn't just a vault for Russian assets, it's a vital hub in global finance. Forcing it to confiscate billions would expose it to lawsuits, disrupt collateral flows, and create hesitation among major investors who depend on Euroclear's stability. If confidence in Euroclear wobbles, so too could the broader European bond market. Russia has already shown its willingness to retaliate. After its assets were frozen abroad, Moscow blocked access to billions in Western-owned funds inside Russia. Euroclear has already taken a hit of about €3 billion from these moves. If Europe escalates to outright seizure, Russia could double down, seizing more assets, sanctioning European companies, or weaponizing its remaining trade leverage. All these pathways converge into the scenario Belgian leaders fear, a hit not just to the Russian war chest, but to Europe's own financial foundations. So what can Europe do instead? A few alternatives are on the table. One creative proposal is to create a special vehicle, a so-called bad bank, to hold the Russian assets. This entity would issue loans to Ukraine today, backed by the frozen funds. If, in the future, international courts rule that Russia must pay reparations, the assets in the bad bank could be used to settle those debts. This avoids immediate confiscation while still giving Ukraine financial support now. The EU's current strategy, using profits from the frozen assets, remains the most practical option in the short term. As long as interest rates stay relatively high, this provides billions for Ukraine without undermining investor confidence in the euro. Some leaders suggest that the principle could eventually be transferred, but only after a peace settlement with Russia. That would provide the legal cover needed to avoid accusations of arbitrary seizure. In effect, the frozen funds would serve as leverage in any future negotiations. These alternatives may lack the drama of outright confiscation, but they reflect the EU's deeper concern how to punish Russia and support Ukraine without damaging its own financial credibility. This debate is far from settled. Here are the key flashpoints to watch in the months ahead. EU policy reviews. Brussels continues to study legal pathways for using the assets. Expect new proposals in late 2025, but consensus remains elusive. Court challenges. Any move beyond using profits will almost certainly be tested in courts. Watch for legal cases in European or international courts that could set precedent. Interest rate trends. The EU's revenue from frozen assets depends heavily on interest rates. If the European Central Bank cuts rates in 2026, the flow of money to Ukraine could shrink dramatically, forcing new debates. Geopolitical pressure. Poland, Estonia, and other hawkish states are lobbying for bolder action. Meanwhile, France, Germany, and Belgium argue for caution. These divides could widen if the war drags on. Russian countermoves. Any hint that Europe might move from freezing to seizing could trigger preemptive retaliation from Moscow through energy policy, trade bans, or further seizures of European assets in Russia. In short, this story isn't static. It's developing, and each policy shift carries consequences not just for Russia and Ukraine, but for the euro and global markets. So, could seizing Russia's frozen €200 billion really crash the euro? Probably not in a single dramatic blow. But the risk lies in credibility. The euro is strong because investors believe their money is safe under European custody. Break that trust, and you plant seeds of doubt that could grow into lasting weakness. Belgium's warning is essentially a cautionary tale. Don't torch the euro's reputation for the sake of a one-time payout. The interest from the assets already provides Ukraine with billions, but more importantly, keeping the principle intact preserves Europe's credibility as a safe financial hub. The dilemma reveals something deeper about Europe's balancing act. On one hand, there is enormous political and moral pressure to make Russia pay. On the other, there is the quiet, technocratic voice of financial stability, reminding leaders that global trust is hard to build but easy to lose. For Ukraine, this means continued reliance on interest revenues and Western loans, at least until there's a legal or political settlement that unlocks the frozen principle. For Europe, it means threading the needle, punishing Russia without undermining itself. As the war grinds on, the pressure to go further will only increase. But for now, Belgium's stance is clear: use the goose's eggs, not the goose itself.